Welcome to Jeff's World, the weekly 30-minute show where our goal is to help you make more informed investment decisions. We're going to cover some key opportunities and risks for investors, time developments around the world, and we're going to take your live questions from the chat on YouTube. So you can ask us what's on your mind at any time by entering it in the chat, whatever your question is, and we'll get to those questions in a few minutes after we share some of our latest insights. Now, I do have a few required disclosures before we get started. Because we don't know you personally, we don't make personalized recommendations, but we do talk generally about the markets and sectors and areas of investing we think are likely to perform well or poorly and why, though we don't provide an outlook for specific stocks. And of course, things can and do change, so all the thoughts we share are subject to change as well. And of course, investing has risks, and international investing has unique risks like currency moves, so please keep all that in mind. Now, as is the case every week, I'm joined by Michelle Gibley and Heather O'Leary on the global strategy team here at Charles Schwab. Good morning. Happy post-Turkey Day, ladies.
Good morning, Jeff. Good morning, everybody.
Good morning, everybody. As usual, I'll be watching the chat and looking at any questions, which we will get to those in just a bit. But Jeff, what are we thinking about this week?
Yeah, so, we set aside a good bit of time for questions today. I'm looking forward to that, but I want to start with some developments over the past week and what they might mean for investors. Trump has threatened a 100% tariff on countries that pursue creating a BRICS currency. So is this a risk investors should be focused on? I don't think so. The idea of the BRICS, that's Brazil, Russia, India, China, South Africa, those countries uniting their fiscal budgets, their monetary policies, and debt levels to enable a currency union is not based on this timeline of the multiverse. Like, that is just not happening. Plus, even if you set aside those massive issues, trade within the BRICS bloc isn't balanced. India and South Africa each run persistent deficits with their BRICS partners on a trade basis. So if all bilateral trade were settled in a new BRICS currency, India and South Africa would run out of reserves unless they received counterbalancing investment flows in the new currency from other BRICS economies. So, like, imagine China investing heavily in India, its geopolitical rival, in order to make this work. It's just not happening. And, will those countries promise Trump that they won't create a BRICS currency? No. Will they actually create a BRICS currency? Also no. So I just don't think this is an issue. It's a lot of rhetoric. These countries are not going to be really moving in that direction. What does the political turmoil in France actually mean? So you might have seen some headlines this morning. Could be a no confidence vote in the government in France today or this week, maybe Wednesday. What would that mean if France's government failed? Well, there is a major party in France that's threatening to topple the government this week over budget disagreements. But French stocks, they're pretty flat today. And it should be noted that the rise in French bond spreads to German bonds has so far been more than offset by the overall fall in yields on an absolute basis. The yield on the 10-year French government bond stands at 2.87% this morning, well below the level of 3.11% on June 7th. That was when President Macron called a snap election, which had now kind of thrown the political situation in France into some turmoil. So yields are actually lower. So the macroeconomic impact of this higher sovereign risk premium as a result of this turmoil is very limited, to say the least. Now, if the government survives, the budget may move ahead. The European Commission last week stated that France had actually set out a very credible fiscal plan to make its debt sustainable and bring its deficit down to the 3% target within the time frame allotted by the EU. So that would satisfy the European Union's demands for, sort of the debt limits, the debt ceiling, if you will, in the Eurozone. And that should allow bond spreads to narrow once again. But if France's government does collapse, there aren't really precedents for a government collapsing so close to the year-end deadline for a budget. You'd likely see emergency measures, which would permit the collection of taxes and authorize some spending in order to avoid a government shutdown. And it would mean France would have to redo its budget, but it would likely lead to more spending, not less, since these issues are over how much fiscal tightening the government bakes into 2025. So rather than getting the deficit go go from 6.1% last year to maybe 5%. Maybe it just goes to 5.5 or something like that. So less fiscal tightening than planned. That would actually be a boost to France's GDP growth in 2025. So, there's some mixed issues here, but overall, faster growth, and bond yields actually coming down, not exactly a big issue here for markets. And that's why, we're not seeing much of a stock market reaction here. Not big of a deal for investors, despite the headlines over a collapsing government, which always sounds worrisome. What else? We got one more thing I want to cover. We've got a big announcement from President-elect Trump last week of 25% tariffs on Mexico and Canada, and additional 10% on China to be implemented on day one when it gets into office in January. To me, it feels like, we're talking about timelines here, multiverses. It feels like I'm in a time loop, because this is exactly what he talked about back in 2019. So now he's saying, look, unless these countries address drug trafficking and illegal border crossings, he's going to put these things into place. Back in May of 2019, President Trump announced a 25% tariff on Mexico. It was 5% at first. That was going to be imposed on June 10th, and then increased by 5% each month until it hit 25%, until Mexico substantially dealt with the flow of migrants through its territory. But the tariff threat was then dropped by the president abruptly days before it was to be imposed, after Mexico agreed to pursue an enforcement surge at its southern border. And even here you can see the president tweeted out a big thanks. Again, the latest tariff announcement for day one is designed to extract concessions on drug trafficking and illegal border crossings, which means Canada, Mexico, and China, again, have time to head them off. President-elect Trump seems to be using tariffs as a tool of statecraft rather than actually expecting to implement them as part of economic policy. It hasn't really disrupted the markets very much. No one really expects this to happen. Already you've got the Mexican president sending a letter to President Trump saying, hey, look forward to working with you on this more or less. So I don't think this is going to go in the direction of the tariffs. And if you take a look at what markets will be most impacted, Mexico and Canada are the U.S.'s biggest two trading partners. So the economic ties are very deep, but U.S. investors probably have very little exposure to these two economies. And that's because Mexico makes up less than 2% of the emerging market index, and Canada isn't even in the EFI index of developed countries, because that index is designed to track Europe and Australia and the Far East. Canada's not even in it. So you're not even really seeing much of an impact there. So look, I imagine they'll work out a deal before day one, but that doesn't mean there aren't other ways Trump's policies could impact Mexico. And one way could be through deportations. Mexico received $61 billion in remittances from the U.S. in 2023. According to data from their central bank. I don't have all the 2024 data yet. And that accounted for 96% of all the money coming into Mexico. So Mexican-born nationals living abroad, sending money home, 96% of that coming from the U.S., and making up 3.4% of Mexico's GDP. So remittances are coming from the 12 million Mexican-born population in the U.S. The Department of Homeland Security estimates 5 million of those 12 are in the U.S. illegally. So if all those 5 million were deported, not at all likely, but if they were, it's possible that remittances to Mexico might fall by more than 1% of GDP. And in its October estimate, the IMF forecast 1.3% GDP growth for Mexico next year, meaning Mexico's economic growth could be entirely wiped out with a mass deportation effort, without trade factors even coming into play. So it's certainly something that could be economically impactful to Mexico, maybe even more so than tariffs, something we'll be keeping a close eye on here. You can see the surge in remittances that have been coming to Mexico over the years, even through the last Trump administration. So, okay, with that out of the way, take a big breath. Let me take a quick step back here and look at the outlook for 2025. I'm going to publish today. We've all been working on this, the whole team, on our outlook for 2025. And that's going to publish later today on Schwab.com. So I encourage you to check it out, take a look at it. It's going through the pipes right now. A lot of work involved in that. Many, many months we've been working on this. It's going to be released later today. I'm going to give you a little sneak preview of what's in that right now. So the first thing I'd say, I guess if I had to sum the whole thing up in 30 seconds, I'd say the overall outlook for global GDP growth in 2025, it's likely to overcome these hurdles, right? The hurdles of the trade war, of tighter fiscal policy, particularly in Europe, and even slow global economic growth. I think overall economic growth in 2024 is probably going to be around 3%. That's similar to what it was, I'm sorry, for 2025, similar to what it was in 2024, 3%. Now, economic growth in the two largest economies, the US and China, is expected to slow next year, but nearly everywhere else, growth is expected to improve. In fact, not one of the top 45 economies in the world are expected to be in recession next year. And most are expected to grow faster in 2025. I'm talking about Europe, Japan, Canada, the UK. And that's just not just our view. That's the view of the consensus of economists tracked by Bloomberg. It's the outlook for the OECD, outlook for the IMF, the World Bank. This is the forecast of most forecasters next year. Global economic growth remaining close to average, a little bit below average, but accelerating in those non-US economies ex-China. And as a result, earnings growth may also improve, and combine with rising valuations, which have been supported by central bank rate cuts, to boost returns for stocks in the developed international EFI index. Now, to outperform, international stocks need to see market leadership broaden from the US AI-driven stocks to other sectors. Interestingly, financials have been the best performing sector in Europe in the second half of the year, taking the lead away from tech, and that could be a sign of shifting leadership in 2025 that would benefit those markets. So that's kind of the overall, excuse me, overall view for 2025. We've already talked about tariffs today. What I said about Mexico, I think, applies to most of the proposed tariffs in 2025. They're negotiating tools and not really economic policy, in my opinion. So the impact on growth and inflation may be pretty muted. And we've talked this on the show before, but the IMF's trade war scenario that they did in late October, 10% across the board tariffs by the US on everybody else, and even between Europe and China, 10% tariffs, raising those tariffs would only shave about 0.1% off of global GDP next year. There are definitely differing regional impacts. I won't go through all of them. You can find them in the Outlook published later today. And I'll post on my X feed and my LinkedIn feed as well. But let me quickly talk about Europe, and then Michelle, you can talk about China. Those are the big two. So European stocks represent the largest weighting in the EFI index, 54% roughly of the EFI index. And the combined economy of the European Union is the world's second largest after the US. So when we look at what's going to go on there, I think it's relatively important, even if you're just thinking about US companies and their international sales, they've got a lot of exposure to Europe. So after economic and earnings downturns in Europe over the last couple of years, 2023, 2024, you can see in this chart here, we had a number of periods of red where economic growth was contracting in a lot of these economies. You didn't see that across the bottom there for the US, and France tended to skirt by. But most other countries around the world, of the G7 here, really did see weaker growth, little recessions, rolling recessions throughout the last, let's say, 6 quarters or so. But it looks like growth is bouncing back and getting a rebound in 2025. But the acceleration is likely to be mild. Economic and earnings growth are likely to improve, but they might remain below average. One of the offsets to this fiscal tightening in Europe, as those budgets are brought in line, may be sustained wage growth amid disinflation, which has seen actually real wages rise for 4 straight quarters in Europe now. So meaning wages are rising faster than inflation. That's a nice turnaround, something I hadn't seen for quite a while. So that's really starting to help things out, helping Eurozone workers recoup some of the 2/3 of their real income losses they suffered in the post-pandemic inflation bubble. So they're getting all that back now and over the course of the next year. That could be good news for consumers in Europe. In fact, the latest economic forecast from the IMF, published in mid-October, estimates Eurozone GDP growth at 1.2% in 2025. That's not booming, but it's better than 2024's 0.8 and 2023's 0.4. Still a little bit below the 30-year average of 1.5. So that's good news, seeing that begin to turn around. And earnings per share growth should follow that. The consensus analyst estimate is for 8% earnings growth in Europe. That's relatively soft. I'd like to see a number a little bit higher than that, especially given the economic rebound. But that's due in part to just slow domestic growth in Europe's largest countries, coupled with soft demand for their exports like autos and luxury brands, given the soft backdrop in China. I think the rebound is likely to be much softer than what we saw coming out of the 2021 downturn, in 2022 after the pandemic, where you had a big surge in consumer spending after the downturn. You can see the incredible numbers here in 2022. This is earnings growth year over year in Europe, just huge numbers rebounding from the pandemic. And then this dip in 2023, as I said, we've gone through some recessions in Europe. And now we're kind of back to growth, but nothing like the growth we saw in that rebound in 2022. So solid growth, mid upper single digits. That's what the consensus is calling for. But I think you need to see that combine with rising valuations to get really good returns, maybe even double-digit returns. Generally, when we've seen the European Central Bank cutting rates in the past, we've seen PEs rise. In fact, we saw that back in 2011 through 2016. We saw that back in 2009. When rates are being cut aggressively, you can see in the shaded periods of this chart, this is the price to earnings ratio for Europe. In those shaded periods, that's when rates were being cut every time we saw rates go up. So, we don't have a long history. The European Central Bank's only been around 20 plus years, but this is what we're looking at here. And so this time as well, I think we'd likely see on the outlook for accelerating earnings and economic growth, investors willing to pay up a little bit for that. And so valuations rise along with declining interest rates. So that's relatively good news, I think, for Europe as we look out to 2025, one of the areas that may perform the best. But Michelle, in contrast to that, maybe you can enlighten us on what you see for China in 2025.
Yeah, maybe if we could go back just a chart. There was a question in the chat about the earnings growth there, if those are year over year or quarter over quarter numbers.
Yeah, great question. So that's year over year, this little YOY percent there up in the top. So this is just looking year over year. And the reason we do year over year is because you want to look at the same group of companies. Not every company in Europe reports every quarter. Some report on a semi-annual basis. Some report have weird fiscal years, and so they report a different. So you want to capture the same group of companies and compare to what their earnings were a year ago. So that's why we look at it not just what did they grow for that quarter, because you may have a totally different bunch of companies reporting that quarter than did the prior quarter. So it's not apples to apples. So looking at it on a year over year basis is very important. So those early numbers you see at the beginning of the chart there, like the first quarter of 2022, that's a comparison to the first quarter of 2021, where we were still, mired in the downturn tied to the pandemic. So big rebound. I just didn't go back that far. I could have. It was miserable numbers. But big rebound there in 2022. And in the softness as we came into 2023's kind of rolling recessions. And then that improvement we started to see here in just reported third quarter, where actually earnings in Europe exceeded those for the S&P 500 in Q3. And so, you can see what the growth rate is expected to be over the coming quarters. No guarantees on this. They're just the forecast, but they're modest forecasts. And I think that's reasonable. If these were 20% earnings growth forecasts, I'd be very cautious in the outlook on Europe for next year. But expectations are fairly low, and I think there's even a chance that companies could exceed these relatively modest numbers. Thanks, Michelle.
Okay, I think we wanted to go on to China next.
Yeah.
We talk about China a lot because it is the world's second largest economy, and for a long time, contributed the largest amount to overall global growth. It's still, 18% of the global economy. Its growth has slowed, but despite its size, it's still considered an emerging market due to its per capita national income, and that's really the threshold set by the World Bank in terms of classification for an emerging market. China's growth has been hindered by a government-induced property market slowdown, low business confidence, and that's been due to some abrupt policy changes, and then consumer sentiment that's just never really recovered from the zero COVID lockdowns of 2022. Now, Chinese policymakers are providing support to reduce the downside risks in its economy, but they really haven't decisively shifted to demand-oriented stimulus, and it seemed to appear, to lack the sense of urgency we saw initially at the end of September. However, China's economy could pick up in the near term as they have reaccelerated some fiscal spending this year, and if companies pull forward deliveries of goods in anticipation of future tariffs. I think we're already seeing some of that. But growth is likely to continue on its gradual slowing trend, and it's likely to decelerate next year relative to this year. I saw a question in the chat about the tariff impact on China. And it's important to note that U.S. demand for goods from China generates less than 3% of China's GDP. If we assume currency exchange rates hold steady and there's no redirection of exports from China through other countries, an increase to 60% in tariffs could lower GDP in China by 1.1%, according to the IMF. But the currency would likely depreciate, and we've been talking about that recently, and there's likely to be some transshipment of goods, so the impact could be less than 0.5% of GDP. Now, the weakening outlook for China's economy, combined with these trade risks, though, do mean that earnings growth could fall short of the street forecast for 9% earnings per share growth for companies in the MSCI China Index next year. Now, we've seen the China Index, MSCI China Index, bounce off its low made in September on these announcements of new stimulus. But the gains have faded because they, like I said, have not really followed through with decisive stimulus on the fiscal side. Given the difficulty in predicting government action, investors might want to keep any exposure small. Now, China's stocks could suffer from a below average domestic and global growth environment, but the valuations are already quite low. So expectations are low. And so if there's any improvement in growth or stimulus, we could see another rally. One thing, you were saying earlier, Jeff, about, kind of a deja vu. Since Election Day, we've seen the market interpret President-elect Trump's policies as good for U.S. small caps, and then the worst for emerging market stocks. And that's also what happened in 2016 when Trump won. We saw U.S. small caps lead the gains, and then emerging markets, and those suffered the worst returns. And then that quickly changed, and we saw the flip of that during the first year of Trump's term. In 2017, we saw EM was the best place to be, China leading the way with a return of 56%, followed by developed international, then U.S. large caps, and then the least good performance was from the U.S. small caps. And that's because economic and earnings growth were improving for most countries in 2017. And we've also been saying that economics have more of an impact on elections than elections do on economics. And so next year, we expect economic growth in most countries to reaccelerate, providing a boost to the most economically sensitive companies, which are more prevalent internationally.
I just want to echo what you said there, because I think that's really important, right? So right now, it just seems so obvious U.S. stocks are going to outperform international stocks given, Trump's policies, and they are right now, certainly since the election. And emerging market stocks are probably going to suffer the worst, and small cap stocks are probably going to do the best, and they have been. And yet, if we go back to the first year of Trump's first term, the exact opposite happened, right? That's what played out right after the election. So from the election 2016 to the end of the year, sure, small caps did great in the U.S. and emerging market stocks were the worst performers. But imagine just going back to the beginning of 2017 with Trump coming into the office and saying emerging market stocks are going to be up like 50% this year. People would be like, "What are you talking about?" And that's exactly what happened. And the reason, of course, is, as you point out, global economic growth accelerated. Well, that's what we're forecasting for 2025. So you don't want to be too quick to write off international stocks, particularly emerging markets, especially given where valuations are and the relative economic momentum around the world. It could be surprising to many investors piling into those Trump trades. So, yeah, just a good warning out there, because it just seems so inevitable right now. That's exactly when everybody's on one side of the boat. And at least the markets strip everybody up. So, all right, great stuff. So, Heather, what are we hearing in the chat?
Well, we don't have too many questions, but we do have a policy question. Is there a limit on the percentage of tariffs that Trump can impose before needing additional government action? Can you kind of explain the process a little bit?
I won't go deeply into the process, but you're on the right line of thinking here. There are limits to what the president can do with an executive order, less around the amount of tariff and more around the breadth of the tariffs and the duration of them. So the president does seem to have the ability, given what Congress has delegated to the president, to pick a particular product and for national security reasons or other reasons can say, I'm going to put a massive tariff on this. It's really almost no limit on what that tariff could be on a particular product that he feels is in the best interest of U.S. security. Very limited, however, in across-the-board tariffs, suggesting every single product coming into the U.S. is a security risk to the U.S. and therefore must have a tariff applied to it. Different rules around that, generally, that kind of thing would normally need to be ratified by Congress. So we've not seen across-the-board tariffs before, very specific tariffs on specific products from China, for example. Those seem to be allowed. Broader tariffs allowed. Doesn't mean it couldn't try, but we haven't seen something like that before. And the way the rules are written, it suggests that that's not an easy thing legally to get done. Second is the duration of those tariffs. The president has the ability to enact tariffs for about a 5-month basis. After that, they would, in theory, need to be ratified by Congress. So, you can put an initial surge on a tariff on a country, probably to try and get some concessions out of them. That has worked. That's for the Trump administration. Probably is approach again this time. So talking about maybe a big tariff on a narrow product or a set over a short period of time is probably the most likely way we get concessions and use this as a policy for statecraft rather than actual economic policy. So there are some limits there, more in the breadth of the tariffs and the duration of them, not so much on the actual amount of the tariff itself.
Very interesting, Jeff. Now, we do have a question. I'm going to direct it to Michelle. We have looking at China's stock market quickly jumped 20 to 25% and then fell back maybe within a week or two after prior announcements of stimulus that didn't quite pan out. Do we have any expectation of additional announcements by the Chinese government?
Well, the next potential time for an announcement would be middle of this month. The Central Economic Work Conference is a big policy meeting. We could hear some broad strokes for 2025, but it's possible they wait to give the details until the March National People's Congress, and that would also give them some time to hear a little bit more in terms of what kind of things to expect from the Trump administration. And, the Chinese markets, I think it's one thing to think about is that there are several of them. There's Hong Kong, which a lot of international people invest in. And then there's the mainland markets, which is mostly retail investors within China.
Anything to add, Jeff?
No, I think, one of the hardest things about forecasting what Chinese markets are going to do is because we have no idea when a new announcement will come out. And announcements tend to move the market when it comes to Chinese equities, particularly where they're trading now. So it's very hard to see. I think the answer is, will there be another announcement by China that can move the market? Yes. When that will happen, difficult to say. So I think that's one of the problems with looking at the volatility of China's stock market, and one of the reasons why I would say very difficult to trade that market, and more of a long-term investment makes more sense there. A small percentage of a portfolio held over the longer term makes more sense in day to day, just given the opacity of these news releases that come from the Chinese government.
Great. Well, it does look like we have time for one more question. Do we have any thoughts on crypto, especially in the post-election surge?
The only thing I'd say about it is that, it's one of these Trump trades, right? Clearly and obviously tied to the idea of Trump creating a strategic coin reserve and maybe appointing folks in charge of certain agencies that will be more friendly to crypto. But like I pointed out earlier, or like Michelle pointed out earlier, we can see these trades reverse very quickly, just as we saw in the post-election period in 2016. What we saw rally the most obvious, U.S. small caps are going to do great, really underperformed dramatically in the following year. And something like that could happen to crypto again. In fact, the dollar, a total win in 2016. The dollar started to move up through 2017. The dollar was even down. So, you get a lot of potential for reversals of the Trump trades. We saw it last time. Could see it again this time. So there's a potential for a pullback rate. Given the volatility dramatic some of the moves can be in crypto, I'd just be a little bit cautious committing too many assets to that. But hey,
Thank you
thanks.
so
Well, that's great. So I do appreciate the questions, everybody. Love them. They're my favorite part of the show. Just hearing where your heads are at, what you're excited or interested about. So definitely look forward to always doing that as part of the show. Your contributions. We'll always make more and more time for that as we get more and more questions. So thanks, everyone. And thanks, Heather and Michelle and our producers, Andrew and Gabe, and everyone for those questions and joining us each week at 11 a.m. Eastern, or catch the replay on YouTube. Also, be sure to click like on the show and share your comments on what you're watching in the markets. We'll see you next week.